Okay, we're in March. As always, first order of business is to bill our clients, right? As February is over, we have all of our time cards, all the employee information in. Let's bill the clients, right? That's what it's all about. Let's invoice them. All right, customers, create invoices, right? Time and expense, we can use this, we can use our own, this one is fine. So let's get to it. All right, we have DeCre properties. Again, you can see that all of our activities for February are showing up here. That was the cool part of us entering it earlier. Select all. All right, 6,537.50. That matches to what we expected per this printout, right? If we didn't have this printout, that would just be fine. This is to confirm on the simulation. And again, we will do this simulation in other platforms where you don't have that luxury. So you would track those hours elsewhere and then just post them into your bookkeeping system, accounting software. But anyway, here we do. Let's go ahead and again create this invoice. We pick this out again. What I wanted to demonstrate, and we entered the time cards for January. We will not enter them on video going forward. We'll just upload them. However, it is important to understand that when time cards are entered or posted, they do not impact debits and credits. But then that information is used to impact debits and credits, and that's what we will concentrate on. All right, so here's that invoice, right? The invoice date would be March 1st, right? We're doing it as of March 1st. Here's our invoice number, debits and credits, right? Once we send this invoice out, unclick email later. I promise I tried modifying the preferences, it still shows up. But again, our objective is not so much the technical nuances of QuickBooks, but so much the debits and credits to fundamental accounting, because a lot of people forget the fundamental accounting behind the software, and then the software is useless. I see so many people fascinated with all the gizmos of the software, and I want to remind them we're not software engineers, we're not software operators, we're bookkeepers and accountants. And so with that, let's continue. Accounts receivables goes up, right? Because it's an asset. It has to be debited, right, for it to go up. What else is going up? Well, we have all these categories, right? And we have them mapped to certain types of income, right? So in this case, we have business consulting, bookkeeping, income tax, so on and so forth. In aggregate, what they all roll up to, we made that modification, is to account 41,000, which is service revenue income, right? They're all sub accounts of that, and I can show it to you real quick. Right, here they all are. 41,000 serious, and then there's one for discounts. So what, to save time, we're all gonna just show it. They all roll up, they all go to 41,000. 41,000 is not a posting account, right? It's a summary account, but they would post through the mapping to this ones, right? And so on and so forth. So let's just indicate that. So what's going on? So these amounts here, they're credits to 41,000 series accounts, right? Ultimately, they all roll up to 41,000 and that's credited. Why? Revenue goes up when credited, right? Accounts receivable goes up when debited, right? Because it's an asset. At this point, we're not receiving cash and that's why we're booking it the way we are. So let's continue. Next one is Temp Services. Okay, we can select all. Here they are. 3, 2. Okay. Firms now 10. Some of those adjustments again, it matches, so all good. What's going on here? 5, 6, 5, 5. 5, 6, 5, 5. Here it is. income tax, and business consulting. On this one, do we want to show the breakdown? Sure, it's a little bit easier, right? Less time consuming. But here it is, right? That's how it rolls up. What do we have? We have income tax, that's our 41,500, 41,500. And we have business consulting, and that is accounting services income, and that is 41,100, 41,100, right? So that there it is right here. Consulting gets 78, and then the rest goes to 2340 plus 2340 plus 1. There it is. Debits and credits are in balance. So these amounts here, they're credits. So these three, sum of these three is this credit, 4,875, and this one is a credit to 41,100. They all roll up to 41,000. So this is just as good, right? Especially for tax purposes. Just wanted to show debits and credits. They're here. Every interface that posts to general ledger has a debit and credit behind it. Whether you know it is a separate question, right? But as a bookkeeper, as an accountant, you should know it, right? Because otherwise you don't know. Are you debiting? Are you crediting? What are you impacting? So that's why it is extremely important to know debits and credits behind each interface. And now you do. Now you do. You know that this amount will be debited to 11,000, and these amounts will be credited to 41,000. Okay, and we will continue with that because practice makes it perfect, right? The more times we get through the iteration, the more it will sink in. Next one is snacks. All right, you see all this data, all this time cards data is now useful. But before, it didn't impact debits and credits. But now that we selected, ta-da! Here it's all converted into debits and credits. All right, here it is again. Very, very important to understand debits and credits because again, trust me, when I interview bookkeepers and they don't understand debits and credits behind interfaces or transactions, that makes me very sad. It frustrates me because again, it's so hard to have conversation with them afterwards. Anyway, all of these, they're credits to 41,000. This is a debit to 11,000. Let's continue. There it is. All right. Yep, matches. So 5,655. It's all income tax, so that's one way to show it, right? Let's do it both ways. 5,655, 5,655. So this amount right here, 5,655, is a credit to account 41,000. 41,000 is not a posting account, as I showed. It rolls up a bunch of other types of revenue accounts to that one summary revenue account. 11,000 as accounts receivable goes up because it is an asset. Assets go up when debited, right? And technically that's what's happening. We send out the invoice. We haven't received cash yet, right? So, but we did say, okay, this invoice is for revenue, for our sales. So sales go up and accounts receivable goes up because we're expecting that money. All of this is income tax. So that's, let's see, tax preparation services income. So that's 41,500. So that would also be an accurate way to show it because these amounts, since they're all income tax, they would post as a credit to 41,500 and then roll up to 41,000. Right? Makes sense. Good to go. Debits and credits are in balance. That's what we want. Save and new. Sure. All right. There it is. This one. And again, see, we select them and then they become Then we can start turning them into debits and credits. Ta-da! Yeah, it's income tax, so technically we can stay here. 645. Again, I use them interchangeably with 41,000. Why? 41,000 is where everything rolls up, including 41,500, as I have showed you. So these amounts, each one of them is a credit. In sum, they're this 6,045. They're credits to 41,500, and then this amount is a debit to account 11,000. Alright, yeah, doing some income tax returns. It looks like, yeah, it's the beginning of the tax season for this office, and you can see a lot of income tax work, right? So 7,312 and 50 cents. There it is. It's a debit to accounts receivable, 11,000. It's a credit to revenue. Revenue goes up when credited, accounts receivable goes up when debited. Okay, see how cool it is? It comes up and we can just use and enter to us. This one is business consulting. So that's accounting consulting income 41. I must have mislabeled it on one of them. And again, it's different type of by revenue buckets. Probably not a big deal. Right? Again, it booked correctly, just I didn't show it necessarily correctly, so maybe I should stay at 41,000. But anyway, to show you different, they all, again, all revenue rolls up to 41,000. They're all credits to 41,000. But in this case, it's 41,300 consulting, right? Consulting income. So here it is. Debits and credits are in balance. This amount right here, it is a debit to 11,000. This amount is a credit to 41,300. This amount is a credit to 41,300. In sum, they're 2,340, which are credit to 41,300, or alternatively rolls up as a credit to 41,000, which is our overall revenue account. All right, we're good to go. All right. There it is. Again, another income tax. We're not going to break it down anymore. I'm just going to show it to you here. What is debited and credited behind this interface. And I'll just keep on moving. Pick up a little bit of this. It's nice. Packing. All right. Same thing. Debits and credits are in balance, and you know debits and credits behind this one. $23.2. Alright, good to go. Save new. What is this one? Okay. See how cool it is that we entered it all in time cards? And all these things do, they increase our accounts receivables and they increase our revenue, right? When we get cash, we will not touch the revenue, right? Remember, we would impact the undeposited funds and then the bank account. But we'll go through it again. in case you don't remember, to solidify that knowledge. Alright, it seems like we are reusing some of our invoice numbers. I'm not sure why. There'll be some glitch there, but again, it's less important. We'll straighten it out. Customer. What's important are truly the debits and credits. If we are off a little bit on some of the invoice numbers, we can fix it. Okay. Debits and credits are in balance. Let's continue. All right. Debits and credits are in balance. Let's continue. Here it is again, all of it comes up. Again, remember right now it's not a debit and a credit yet or anything yet, right? Until we apply it. Once we apply it, we click this OK. And here it is, income tax, right? Suddenly, all that info, and let's see, let's just tax preparation services, 41,500. And we could just do that. Actually, let me do this. Right, we can also depict it as like this. Let's see, 620. Right, still balances, right? Because we have fewer line items here, so we can actually show the whole thing. We can show this one too, right? So again, you see we have these two line items. The total is impacting accounts receivable, and then each one of these individual ones, right, is a credit to, in this case, tax preparation services income, and then correspondingly it rolls up to 41,000. There it is, debits and credits behind it. Okay. Okay. This one has a little bit more, but 1, 2, 3, 4, 5, 6. Let's dissect this one as well, just to show you the debits and credits. So we have our bookkeeping, that's 41200, and that's 23750. We have our payroll, not payroll. Let's see, services 41400, 41. Right, that's another way to demonstrate what's going on. More bookkeeping. More bookkeeping. And one more payroll. All right, debits and credits are in balance, right? And you see what is debited, what is credited at a more detailed level. And again, maybe we'll do that at that level in April as well. Why not, right? But here it is. So this total right here is impacting our accounts receivables, and it's going to debit it because accounts receivable is an asset and it goes up when debited. Each one of these line items impacts correspondingly our revenue account 41,200, 41,400, and therefore drives it up because revenue goes up when credited, and each one of those is a revenue account. So each one of these amounts goes to a revenue account, increasing it because it credits. All right. So here it is again, right? You see the debits and credits. So let's provide a few. And we can just set it all rolls up to 41,000 because there's a lot of line items. And we could essentially dissect them as well, right? So all the bookkeeping ones, they become credits to our bookkeeping services income 41,200. And then all the income tax, these two line items, they become credits to our tax preparation services income, which is 41,500. Okay. Tax preparation for 1,500. This one is easier, right? We can just show it. So there it is. This amount right here, it is a debit to account 11,000. This amount right here is a credit to account 41,500. All of it is bookkeeping. Our bookkeeping service is 41,200. And so we can do that. Right, there's different ways to depict this one. Let's just, on this one, let me just show different ways. This is correct, okay? This, some of this is a credit to 41,200, and 665 is a debit to 11. What else? Well, we could also do this. Right? Right, that is correct too. All right, we can also do this. Right, that is correct too. And so is this. As long as debits and credits equal each other, right at the total, at the sum, we're good. 15. Should be to versus fix them up. All right, next one is looks like we're doing some individual returns as well. Again, debits and credits are in balance, and we know what is being impacted. Same thing, but again, practice makes it perfect. This is a credit, right, to 41,000 serious account, and this is a debit to accounts receivables. Yeah, looks like we started entering the taxes and doing some individual returns. And that's all goes towards tax preparation services, so we can show it as well. Right, so here it is. This amount right here is a credit to 41,500. This amount here is a debit to 11,000. Neither one of these two accounts are shown here, but they are there. They're there. similar. Okay. Okay. Those are some of our individual taxpayers that we do work for. Debits and credits are in balance. So far, so good. Good to go. Okay, select all. Because we keep good time tracking, we can use it really. Okay. 14.2. Okay. Tax preparation, 68250. 68250. Debits and credits are in balance. So this amount right here, it's a credit to 41,500, right? And 41,500 is our tax preparation services income. It goes up. And then accounts receivable goes up because it's a asset. When debited, it goes up. So they owe us more money. Accounts receivable goes up, and we have revenue that earned that money that goes up as well. So we're good. Let's see, it's the last one. Save and close. Yes. So that kind of concludes billing our clients. All right. In February, I mean in March, we started the month out with billing our clients, and next we'll start receiving those payments from our clients. Before that, we issued a credit memo, right? Credit memo to our one of our clients right here. Let's go ahead and post it. Previously, we posted that credit memo when we were collecting payments. This time, we'll just post it before we start. So here it is. Again, create credit memo refund right here. Customer soft drinks. Okay. Date. Sometime after we issued the invoice, we probably got a call from the client or something like that. And after conversations, we decided that we will give them a discount, client discount right here. And then the amount will be 731.25. Okay, debits and credits behind them, right? Debits and credits behind them. Very important. Always, 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 always gotta know your debits and credits behind them. So, first of all, what is being impacted? Well, again, our accounts receivable balance will be reduced because the client no longer owes us that money. So we can get that out of the way. We know that accounts receivable is an asset. Assets are reduced when credited. So that's what we do here. We reduce our accounts receivable balance, the amount of money we expect to receive from that client. What else is happening? Well, our revenue is going down, right? And we don't want to necessarily allocate it proportionally to whatever type of revenue we did with that client. So what we use a contra account called customer discounts, client discounts, and we call it 49900. That account is a revenue type account. So when it is debited, it is reduced. And then again, it is rolled up to 41,000 series account. right, at the end of the periods, and so it will impact our overall revenue. We alternatively could have also shown it like that. All it does, it reduces our revenue. Revenues are reduced when debited. Accounts receivable is reduced when credited. So in a way, it's kind of reversal of what we just did a few minutes ago. All right, again, this amount right here, it is a credit to accounts receivable, 11,000, and it is a debit to 41,000 serious account. And in this case, we have them linked to where they impact 49,009. Right? So here it is. Let's go ahead and save and close. Apply to an invoice, of course. We will apply to the invoice, and here it is. They're asking us, do we want to apply to the invoice right now? And why not, right? So here's the invoice original, and you'll see it when we pay. So amount due, and then we'll apply this. Okay. That's it. Right? We just processed this. It reduced our accounts receivable, so therefore the amount of money we expect to receive from clients has been reduced by this amount, and our revenue has been reduced as well, because we thought we earned that money, but we didn't. All right, next we get to collect money from our clients.